And there we have it. We're in number 8. This is the review session number 8 for macroeconomics. This one will focus on the Federal Reserve System, its tools, and how we graph the money market and the actions of the Federal Reserve and the Federal Open Market Committee. So, first thing is, what is the Federal Reserve? Sometimes you need to know that. You need to know it probably for a multiple choice question. I'm not going to review it here. I'm going to admonish all of you. Go back to the book. You know where it is. Look through the text that describes the Federal Reserve System, the 12 districts, how it's formed, who serves on which parts of the Federal Reserve, and understand a little bit of the history. Things that you'll need to know to memorize for the multiple choice question about the Federal Reserve. Probably not a lot of questions like that, but there'll be maybe one, maybe two. And that could be significant in terms of making the difference between getting a 4 and a 5, or maybe doing a paper that would somehow identify you as some brilliant scholar that doesn't even need to go to college, but directly to grad school, or maybe to serve on the Council of Economic Advisors. So that's important. Remember, you want to be that student. But in this case, we're going to talk very simply about, first, the Federal Reserve and its tools. So I'm going to leave the structure and the history to you, the tools. So what does it have? The Federal Reserve has a few objectives, 3 different objectives that you'll need to study again. There's the objectives of macro policy. And to achieve those objectives, it has 3 different tools. The first one is one we discussed somewhat in passing in the last session, which is the required reserve ratio. It controls this, it can do things about it, or to it. It has the discount rate. And the third, it has something called open market operations. I expect you to know what that means. I'm not going to write it out right now. So it has these 3 tools. I'm going to quickly discuss what they are, why they would or wouldn't be used in normal times, and kind of Dickinsonian stuff. These are not normal times. Best of times, the worst of times. Unfortunately, almost the worst of times, because as discussed in class, the Federal Reserve has run out of tools to use, and there really isn't a whole lot it can do to try to keep the economy moving or make it move faster and get towards through this recovery. But simply we say the required reserve ratio, we saw last time, we're talking about the expansion of the deposit system. And banks were required, in our simple case, to hold aside 10% of their deposits. We saw before that the required reserve ratio of 10% is utilized in the money multiplier, which then equals 1 over the required reserve. So it's 10%, 1 divided by 0.1 equal 10 in that case. We didn't discuss, and we'll discuss right now, what happens if that percentage moves. What happens if banks are required only to hold aside 5% instead of 10%? So assume required reserve equals 0.05. That's what 5% means in decimal notation. So the money multiplier then equals 1 over 0.05, which equals, well, I can't hear you. Well, we'll just put it down. 20? So we have to think about this. And this is what I would like you to do on the AP, or just when you discuss economics, to utilize a formula, utilize part of the model, and then stop and wonder what it suggests, and does it suggest something that makes sense. So in this case, we're saying that the bank here, if the required reserve ratio goes down, that means that there are less of new deposits. A smaller percentage of new deposits can not be used, or conversely, a greater percentage of deposits available from new lenders or new depositors can be available for new loans. A greater percentage is available for new loans. If that's true, then what happens to the total amount of money on deposit? If more of it can be used and more of it is recycled through the expansion of the money supply, as we saw in the last lecture, in that case, there ought to be a greater expansion of the money supply through this little formula, and that's what we do see. When it goes up to 5, down to 5%, the limitation is smaller than it was before, then the total expansion will be greater. Not a bad tool. That's so great, and why doesn't the Fed use it? We talked about before, the Fed is limited in being able to use this because it's very cumbersome. It's hard. There's something like 6,000 banks in the United States, and we would have to kind of audit through and verify for all of those banks exactly whether they're in conformance or not. People do verify this stuff, but it's a lot harder to look at nuanced changes. And two things: hope that the banks respond to this and immediately supply more loans out in the market, that they're not being conservative, which is what we have seen in the recent recession. The banks are conservative and reluctant to lend the new funds out, and that they actually comply with the right number. So it's an interesting tool, but it's a little bit impractical to use in real life and applications. So yes, it's good, but we don't use it very frequently. That's the answer for you. Number two, discount rate. Discount rate is the rate that the Federal Reserve charges to member banks that need short-term funding. So that for some reason or other, there may be a run on their deposit, the bank finds itself out of formula or out of conformance with the required reserve ratio, it can go to the Federal Reserve and borrow money to make sure it has enough on hand. Bank can do this, but as we discussed before, there's two reasons that it's not a good tool. One is that it would result in banks self-reporting their non-compliance with reserve requirement ratios to the Federal Reserve. And it's illogical to imagine that banks would be excited or enthusiastic about letting the Fed know very soon exactly when they have a cash liquidity crisis. They don't have enough required reserves. That's one. Second is the Federal Reserve lowered this discount rate at the beginning of the recession, hoping that the lower discount rate would enable banks to have a bigger spread or greater profits based on the money that they charge to the borrowers and the money that they're getting from their own lenders. In this case, if the bank pays less to the Federal Reserve to get money, it suggests that the banks would be making more money by taking from the Fed than making their loans. But the conservatism that captured the banking industry in the wake of the housing market bubble collapse restricted or constrained the banks and diminished their enthusiasm, made them very conservative. So even with this lower discount rate, banks didn't want to lend. There was too much uncertainty. So number one, this one's hard to administer, not a very good tool. This one, and even in times, recent times, we find it's ineffective. These open market operations. Open market operations are run by the Federal Open Market Committee. Federal Open Market Committee, which is based in New York, because it pertains to and involves the bonds markets. The Federal Open Market Committee makes decisions about how to implement the policy, or they set the policy, and the policy is to increase or decrease the money supply by buying or selling bonds. We talk about this in class. I always urge you to remember that we've got these two things here. And they're both paper. This one we call dollars, and this we call bonds. If at the end of the day, the Federal Reserve wishes to increase the money on deposit in banks, they want the money supply to go up. At the end of the day, the Federal Reserve wants the banks to have this. This is just one example. If the banks have that, then the Federal Reserve, at the end of the day, must have this. If they have more bonds, the only way to get more bonds was to buy bonds. So buying bonds increases the money supply. If conversely, the Federal Reserve, at the end of the day, had a policy in which they wanted the money supply, the private sector money supply, represented by banks, to be lower, to decrease the money supply, then at the end of the day, we'd want the Fed to have the dollars. If the Fed has the dollars, then it's the banks, the private sector, that then holds the bonds. What did the Fed do? Did it buy the bonds? Well, in this case, other people have the bonds, so the Fed sold the bonds. In this simple picture, if you draw a dollar and a bond in the middle of the AP, when you're in the context of striving for the 5 and trying to remember everything that you know, draw a little picture and reinforce what you know by the visual that you can examine. You can see that. Just ask the question. At the end of the day, do we want the money supply to go up or down? The money supply being the money that's held by private sector banks, not the Fed. So we want the money supply to go up, then the banks would have this. We want it to go down, then the Fed has this. And whoever doesn't have the money is then holding the bond. Bonds are obligations that the Federal Reserve is trading, T-bills, actually government securities, and their obligations to pay money in the future. All you need to know is that the bond is either bought or sold with money. Draw the picture, ask who's got the money at the end of the day, and the other party has the bond, and that'll help you understand whether the bond was bought or sold by the Fed. Okay. Well, that's the end of this description of the tools of the Fed, and then economics review number 9 will start to use the graphs to show how the money supply moves back and forth and what happens to interest rates and how that influences other parts of the macroeconomic picture.